Hello and welcome. Today, I will be sharing information about Bollinger Bands and how this indicator can be used. As a trend reversal strategy, Bollinger Bands are a popular tool in technical analysis that helps us understand price movements. We will learn how this indicator works and how to use it. Bollinger Bands are used to determine how far prices deviate from the average and to identify volatility levels. The middle band represents the average price, while the upper and lower bands are used to indicate volatility levels. These bands can provide valuable signals when prices potentially enter overbought or oversold conditions. However, Bollinger Bands should not be used on their own. They should be combined with other analysis tools and indicators to form a stronger strategy. It is important to consider price movements and other indicators to accurately identify trend reversals. By watching this video, you will learn more about Bollinger Bands and how to utilize the trend reversal strategy. If you're ready, let's get started. We can see that the price has created a significant gap here, surpassing the upper Bollinger Band. The gap itself is not of particular importance to us. What matters is that the price has crossed above both Bollinger Bands, which generates a signal in the opposite direction for us. And then the price retraces back into the space between the Bollinger Bands, indicating a valid pullback. This significantly strengthens our signal for a short position. Now, our focus should shift to the RSI line. With the RSI line crossing below the 45 level, you can open a short position. Let's take a look at another example of a short position. In this example, we can see that the buying group is persistently trying to push the price higher. The price moves above the Bollinger Bands with 3 green candlesticks. By entering patiently and at the right level, we can potentially generate profit from a short position. As you can see, the price is persistently trying to stay at higher levels, but there is a negative divergence between the price and the RSI indicator. Additionally, we can observe a valid pullback movement. And since the RSI line has crossed below the 45 level, a suitable short position trade can be initiated. Now let's take a look at one more example of a short position. We will mark all the instructions on the chart. Did you notice something different in this example? We didn't wait for a valid pullback by entering aggressively. We opened the trade after crossing the middle line of the Bollinger Bands. Sometimes, the price can continue without looking back. Traders who want to trade safely should enter a short position after the valid pullback movement in this case. And now let's look at some examples of long positions. First, we wait for the price to drop below the Bollinger Bands. This situation will give us a signal for an upward reversal. The price persistently moves downwards and then, after making a valid pullback, starts to turn upwards. And after exactly 41 bars, the RSI crossed above the 55 level, creating a suitable entry point, and the result was excellent. Let's take a look at one more example. The instructions will be marked on the chart.